U.S. markets have continued to climb to record highs this year. The S&P 500 and the NASDAQ composite both gaining another 5% in November alone. Well, my next guest says this is no longer a mega tech rally. So what is happening in the equity markets right now? Damian Fernandes, Managing Director and Portfolio Manager with TD Asset Management, joins us. Great to have you back on the program, Damian.
Thanks, Greg. Always a pleasure to be on.
All right, so here we are. We're the last trading month of the year. Stocks have been on a record run. We just got through an earnings season. It's time to pick your brain as to what's going on.
You know what? It's so much more enjoyable coming here on a bull market. It's the Christmas season. Yeah. It's the gift of giving, and like, who doesn't love a big rip-roaring bull market to end the year?
And then, so let's talk about what got us here. What is going on, and well, maybe we can dig into earnings too. I mean, we're past the bulk of it in the States. Sure, Did it show you something to justify what we're seeing in the market?
Yeah, so if I split that into two things, what got us here? What got us here is actually a pretty favorable backdrop. I know that might seem difficult just because it seems so volatile politically, geopolitically, macro, but when you look at the fundamentals that drive stocks, right? Earnings for 2024 are going to be up about 10%. We just had, we had a pretty good earnings quarter. Last year, inflation was still running hot. Central banks had started easing, but as we've progressed through this year, inflation has fallen. We've had, central bank rate cuts, and by the way, the economy and earnings have held in fine. So, if you ask me, would I be surprised that the market's up if we, rolled back the clock a year ago? I would say no, I wouldn't be surprised. I'm surprised by the magnitude, but the magnitude has been helped by and supported by enthusiasm for stocks as a lot of investors who were sitting in money market or sitting in GICs have slowly moved that over to risk assets because we no longer, there's evidence we're no longer going into recession. And earnings are improving. And on the earnings front, it's like, high-level stats. The top line for earnings, Q3 is over. We probably grew the revenues around 5-6%. Earnings grew close to like 9%. That spread means you had operating expansion. Those are all bullish signs for the market.
Markets are forward-looking instruments as well, so if we do have all these bullish signs behind us, we have markets trading at record levels, are they trying to tell us something about what 2025 is going to look like?
Yeah, I think markets are enthused about 2025 because, as I mentioned, right, we're no longer in that have to worry about recession. In fact, people are thinking that the more recent election of President-in-waiting Trump is going to unleash this whole deregulation, enthusiasm, optimism that should support. So it's definitely, and you see it in the charts where you have the charts on every day.
You bought the charts with you as well, so maybe we can start rolling through some of them.
Yeah,
tell us what we're seeing here. So I don't know what we want to show. What chart do you want to see first?
Well, maybe we can show the earnings chart first, right? Just to give people some backdrops on like what's happening here, and that's what has happened year to date. Right, and what we expect for the year. And you can kind of see that most sectors are up, whether it's financial second performing sector, but utilities are up there. So the reason it's like, yes, you've had big tech and, the big six, tech companies, which have had double digit, like north of 20% earnings growth, but it's been pretty broad based. And the sectors that have lagged on the far right are the ones that you understand, which have had challenges, right? Like I'm sure in your update, you've talked about WTI this morning at $68. Like it was north of 75 last year. So obviously if your commodity is lower, it's going to be hard to generate earnings growth. But for the rest of the sectors, you've had broad-based gains. The market earnings the last time they were negative was Q2 2023. So we've had close to 5-6 quarters now of consecutive earnings growth, but people haven't fully digested that. I think that's really positive.
All right, we were talking about the bull markets earlier too. You have another picture to show us here in terms of the bull market and the kind of strength that we're seeing and the momentum that perhaps that we're going to see.
Yeah, let me take a second to explain this, right? This is a breadth chart. This is like earnings going back historically, and you kind of look at that, and the estimates are, and the reason I highlighted this is that the estimates for the next few years are double-digit earnings growth. And look, if we have nominal GDP of 2.5% inflation plus 2.5% real growth, we have a 5% number. We know the equity market grows faster than the economy. It's a levered play on the economy, both on the upside and the downside. So if we have positive GDP growth for the next few years, we could see the top line for these S&P 500 companies growing high single digits. You throw some margin expansion there, which is possible, given particularly advancements in AI and so on. And you could be looking at double-digit earnings growth. The last time we had that was the late 90s. And look, I'm not expecting that we're going to have that degree of outperformance as we saw, but there's precedent for us having a few years of decent earnings growth that should be supportive of markets. Now, am I saying that the market's going to be like this year was outstanding, and that isn't hyperbole? Like, it was an outstanding year. Am I expecting the same magnitude of returns? No, but I think the direction is still positive till interrupted.
And for the longest time, we were waiting for central banks to start cutting rates. Of course, Canada moved first, but the Fed showed up, and they showed us something. Well, we take a look at the S&P 500. We think about the Fed embarking on a rate-cutting path. We don't know where that path is leading at the moment, but what's this next picture telling us?
Oh man, this is one of my favorite things. If you just ask me, Damian, what happens when the Fed cuts rates? And I would say, like most, it depends. And I don't mean to sound, but it really depends. Why are they cutting rates? Are they cutting rates because the economy has tiptoed into recession and now you need rate cuts to stimulate activity? Or are they cutting rates because the level of rates is too high and inflation's moving in the right direction and now we're just recalibrating our rates to a level that's supportive? The reason I'm telling you that is that because you see three lines, right? If you ask me, Damian, tell me what are the returns when the Fed cuts rates, I would say, on average, they're 8%. But as I said, it depends. If they're cutting rates because the economy is slowing and we're in a recession, your next 12 months of returns from when they first start cutting rates is actually flat. It's 2%. It's much below average, right? And actually what happens is that the initial few months, you actually have, markets are negative, and then they get back to flat. Conversely, if you're cutting rates because inflation's falling and rates are too high, so you don't need to stimulate the economy. What you need to do is recalibrate to a level that is consistent with activity. You're up on average 18%. Now, like I said, right? This is from the first rate cut. The first rate cut, you just said it was September. I'm not saying that from September to just what the average is. What I'm saying is that the conditions for a market regime that is supported by easier monetary policy are there. Look, I think that the market's pricing in 3 to 4 rate cuts next year. That might be a tad aggressive, but we're still going to see rate cuts, which is what I think is important.
Okay, you talked earlier about market breadth because, of course, as we entered into this year, a lot of criticism that all the gains that we were seeing in the equity markets were concentrated on those generals, the Magnificent Seven. What are we thinking now in terms of who's taking the baton? Yeah,
so 2023 was a positive year in markets, and it was characterized what I call bad breath. So you kind of see that there in that circle, which are highlighted in blue, just large cap dominance. What's that showing you? So this is showing you the advanced decline line for the New York Stock Exchange. The number of stocks making new highs, less the number of stocks making new lows. So in 2023, when the market was up, the advanced decline line was going sideways, meaning breadth wasn't improving. The market was being lifted up by what you just talked about, these large caps. Look, there are lots of stocks that were going up. It's just that these large cap stocks that had such a big weight in the index, they were pulling up returns. That kind of changed in Q4 last year. And you see that in the chart, right? You see that the median stock now starts making new highs. So it's no longer these generals, this Mag 7. It's the median stock. And I find this quite, quite instructive. Everyone is still so preoccupied with the Mag 7. What were NVIDIA's earnings? What's the outlook for AI? How much is Microsoft spending on CapEx? Or what's Amazon doing next? And in fact, these stocks aren't like Amazon out of those 3 stocks, right? Amazon and NVIDIA making new highs, but Microsoft is 11% off the highs it made in June, right? Tesla got a bump, got a charged bump from Elon's association. But generally, the Mag 7 aren't the talk of the town anymore. It's the median stock, right? It's the JP Morgans. It's the, it's the E&P energy stock that's making new highs. I find that. It's 12 months from now, if we're having this conversation, the Mag 7, the term will actually have just fallen out of usage. We'll be talking about something else.